You know, in business, some numbers tell you a good story, and some tell you half-truths. Today, we're cutting through all of that. We are going to focus on the one number that tells the unvarnished truth about a company's health. This is the metric that separates real operational skill from just, clever financial tricks.
So let me ask you this. With all the data a company throws at you, we're talking sales, growth, market share, what is the one number that really, truly cuts through all that noise? What's the truest measure of its fundamental health?
All right, here's the answer right up front. It's not that big, flashy revenue number that always makes the headlines. And it's not the famous bottom line profit either. The purest signal, the real health check, is its operating income. And by the end of this deep dive, you are going to know exactly why it's the only number that really matters for checking on a company's core performance.
So here's our game plan. First, we'll talk about why it's the ultimate health check. Then we'll get super precise on the what, defining what's in and what's out. After that, we'll cover the how, the 3 different ways you can calculate it. Then we'll put it all in context, comparing it to other metrics, before we see it in the wild with a real-world example from Apple.
Okay, Section 1, the health check. Look, the real power of operating income is its purity. It lets you see how the actual business is doing, completely separate from all the noise of its financing decisions or its tax strategy.
This quote really just nails it. Think about it. Revenue tells you how much you're selling, but operating income, that tells you how efficiently you're running the show. It answers the most important question. For every single dollar that comes in the door, how much profit is the main business actually making after paying for everything it needs to keep the lights on?
And that's why a consistently growing operating income is such a powerful signal. It's a direct sign that the leadership team isn't just chasing sales. They're mastering the business itself, controlling costs, boosting efficiency, and scaling smartly. It's basically a report card on how well the executives are actually operating the company.
Okay, so to really appreciate this, we have to pop the hood and see what it's made of. So Section 2, core profitability. Let's get really clear on what's in and what's out.
So the textbook definition is pretty simple. It's the profit a company makes from its main business activities, before you factor in anything that isn't part of those core operations. Simply put, it's the profit from the main event.
So what gets counted? Think of everything it costs to actually run the business day to day. You've got the direct costs of making your product. That's your cost of goods sold. Then you have all the support costs, selling, general and admin expenses, or SG&A. That's everything from salaries to rent to marketing. And yes, we even include things like depreciation, because wearing out your equipment is a very real cost of doing business.
Now, what we exclude is just as important. Interest payments? Nope, that's a financing decision, not an operational one. Taxes? Those are out too. That's between the company and the government. And any weird one-time charges or gains get kicked out as well. The whole point here is to isolate the pure, repeatable profitability of the core business engine.
Okay, so we know what it is. Now, let's get practical. How do we actually find this number? Well, there are 3 main ways to get there, and each one gives you a slightly different perspective.
The one you'll see most often is the top-down approach. It's super intuitive because it just follows the income statement. You start with your total sales, your revenue, you subtract what it costs to make the stuff you sold, and that gives your gross profit. Then you subtract all your other operating costs like SG&A, and boom, you've got your operating income.
The second path is a bit of an analyst's trick. It's the bottom-up approach. Here, you start at the very end, with net income, and you work your way backward. You add back the taxes, you add back the interest costs. What you're doing is stripping out the effects of tax and financing decisions to get back to that pure operational profit figure.
And finally, there's the internal view, the cost accounting approach. This one doesn't really follow the formal statement. It just lumps all the business costs into 2 buckets, direct and indirect, and subtracts them from revenue. The labels are different, but you end up in the exact same place, a clear view of how profitable the actual operations are.
So, we've defined it, we've calculated it. Now for maybe the most important part, putting it in context. In this section, let's map out the profit family tree, so you can see exactly how operating income stacks up against all those other financial terms you hear about.
First up, let's compare it to revenue. This is simple. Revenue tells you if you're good at selling things. Operating income tells you if you're good at business. I mean, you can have billions in revenue and still have 0 operational profit, which, trust me, is a recipe for disaster.
Next, what about that famous bottom line, net income? Well, operating income is laser-focused on the business itself. Net income is what's left over at the very end, after you've paid the bank and the tax man. And that's why operating income gives you a much cleaner look at the health of the operations, regardless of how the company is financed or where it's based.
And finally, let's clear up the confusion around its two close cousins, EBIT and EBITDA. Now, for most companies, EBIT, that's earnings before interest and taxes, is going to be the exact same thing as operating income. They're basically interchangeable. But EBITDA, that's a different animal. It also adds back depreciation and amortization. And while people say it's a good proxy for cash flow, it can be really misleading because it ignores the very real cost of your assets wearing out, which makes it a much less conservative way to look at profit.
All right, enough with the theory. Let's make this real. For our final section, we're going to put this metric to work by looking at the income statement of one of the most successful companies on the planet, Apple. So in the first quarter of 2025, Apple brought in over $95 billion in revenue. That is a jaw-dropping number that shows you just how dominant they are. But as we now know, that's not the whole story, is it?
Because from that $95 billion in sales, their operating income was just under $30 billion. That giant $65 billion gap, that's the true cost of running the global machine that is Apple. We're talking everything from designing chips and manufacturing phones to all their marketing and retail stores for just one quarter. This is the reality behind the revenue. And this simplified statement shows you the whole journey. We start way up at the top with $95.4 billion in sales. We subtract the cost of sales, and we land at gross margin. Then we subtract all of those operating expenses, the R&D, the marketing, and we arrive at our crucial number, $29.6 billion in operating income. And you can see how after a few more things, the final net income is even lower. This table right here is the story of profitability in action.
So here it is, the big takeaway. Revenue tells you about popularity. Net income shows you the final accounting result, but it's only operating income that gives you that crystal clear, unvarnished view into the fundamental health and the true efficiency of a company's core business engine.
So I'll leave you with this question. The next time you see a headline where a company is bragging about record profits, you'll know to stop and ask which profit. Are they talking about the flashy headline number, or are they talking about the one that shows how healthy their operations really are? Now you know which one to look for.